gold has just done what few believed possible. It broke through the $4,000 mark per ounce, a level that once belonged to the realm of financial fantasy. Front pages around the world celebrate the milestone, and investors, large and small, are rushing in, convinced that the next leg of the rally has only just begun. But not everyone is celebrating. Two seasoned voices, veterans of very different schools of thought, see the same market through opposite lenses. On one side stands Gary Wagner, the calm strategist who predicted this rally months before it began, now standing amid the storm he foresaw. On the other, Todd Bubba Horwitz, a battle-scarred trader from the Chicago pits, who looks at the glittering charts and sees danger, not opportunity. This is not just a debate about gold. It's a clash between fear and faith, discipline and emotion, and what it really means to protect your wealth when the world turns upside down. Todd Horwitz has seen more bubbles than most people see bull markets. To him, the current gold rush looks eerily familiar, a textbook case of panic-driven buying. When gold hit $4,000, he didn't cheer. He sold. In his words, the market is overheated and due for a hard correction. Horwitz believes this move is built less on fundamentals and more on fear of missing out, a dangerous fuel that can burn through even the strongest portfolio. He asks the simple but brutal question, if you buy gold at $4,000, do you have the stomach to watch it drop to $3,500 or even $3,200? For Horwitz, this isn't cynicism, it's discipline. It's the line between being a trader who acts on euphoria and being a believer who gets swallowed by it. Across the screen in another studio, Gary Wagner leans into the microphone and admits that even he underestimated the force of the rally. His original target was $3,800, a level that was, as he put it, taken out like a runaway freight train. For Wagner, that speed is not a warning but a sign of extraordinary momentum. Yet he's no dreamer. He actually welcomes a correction, describing it as a necessary component of a healthy trend. A pullback to him is not the end of the rally but the breath between two sprints. Something deeper, he argues, has changed in the nature of gold itself. For decades, it was seen as slow, stable, almost dull, a conservative refuge for cautious investors. But in the last year, the metal has transformed. The old safe haven has turned into a momentum asset, moving like a tech stock in the late 90s. Between January and September, gold didn't just rise, it accelerated, blasting through resistance levels that had held for years. The market that once drifted by a few dollars a week now leaps hundreds in a single session. Veteran traders are unnerved. Charts that once looked like gentle hills now resemble volcanoes. The question is, has gold truly entered a new era, or is this the final burst before gravity reasserts itself? While the spotlight blinds everyone with golden light, Todd Horwitz looks elsewhere, at a metal few are talking about, platinum. He calls it the real bargain. History tells him platinum once traded for almost twice the price of gold, and its industrial demand is rising fast in a world hungry for green technologies. Horwitz invests dollar for dollar, one in gold, one in platinum. He sees the latter not as speculation, but as a quiet opportunity hiding beneath the noise. When the crowd runs one way, look the other. That's the trader's creed. Meanwhile, Gary Wagner is staring at another anomaly, the great divergence between gold and silver. For 2 months, gold has set record after record. Silver, on the other hand, has barely moved, stuck between $47.50 and $48.40. This split, Wagner says, reveals how the market perceives risk. Gold has become the ultimate inflation hedge, the default protection against central bank uncertainty. Silver, with its heavier industrial role, no longer gets the same respect. Yet historically, when silver wakes up, it moves twice as fast as gold. In the last 6 months alone, silver gained 47% compared to gold's 20%. That volatility cuts both ways, amplifying wins and magnifying losses. Silver, Wagner likes to say, is gold with a caffeine addiction. Both men, though often at odds, agree on one culprit behind the chaos, the Federal Reserve. Horwitz calls rate cuts a deception. They make headlines, but they don't fix the real economy. Instead, they enrich banks, inflate assets, and quietly punish the middle class through stealth inflation. He reminds us, in 1985, a typical home cost $75,000 when the average salary was $25,000, a 3-to-1 ratio. Today, the median salary is $70,000, while a home costs $500,000, a 7-to-1 ratio. Something's broken, he says. And that something is policy. Wagner, for his part, agrees that central bank actions are the main driver of the gold explosion. Markets have already priced in future rate cuts, he notes, meaning the easy money may already be behind us. The next catalyst will have to come from somewhere else. Horwitz sees another danger ahead, one that glitters less and burns more. He calls it the AI bubble. He's been here before, the dot-com mania of 2001. Back then, companies with no profits but plenty of promises soared to absurd valuations before collapsing into dust. Now he sees history repeating in the tech sector. Stocks like Beyond Meat or Tilray once traded above $250 and $300. Now they hover near zero. To him, AI hype is no different, another story of easy money chasing a dream. His antidote? Tangible assets. Metals you can hold, not visions you can download. So who's right? Is Gary Wagner's golden train still running full steam? Or is Todd Horwitz correct that it's about to derail? Perhaps the answer lies in how we think about wealth itself. The investor seeks value over time. The trader seeks opportunity in motion. One builds a fortress. The other hunts the storm. Gold, in this moment, has become both fortress and storm. It reflects our faith in safety and our fear of collapse, two emotions that forever coexist in financial markets. Maybe that's why gold fascinates us more than any chart or algorithm. It's not just a metal. It's a mirror, showing us who we are when the world trembles. In the end, gold isn't about price. It's about psychology, about how humans respond to uncertainty, euphoria, and fear. Whether you see it as protection or speculation depends on the side of the trade you're on, and the courage to admit which side that really is.